In your investing, you talk about a tingle of paranoia. What does that mean?
When everything's going right, you need to get paranoid. And in fact, what I've learned over time is that some of my very best investments have come when I'm most paranoid, frankly, almost nauseous to recommend a new company. A lot has changed. Countries change. The investing universe is better. Countries themselves, their financial structures are better. Inflation is more under control. There's less government debt. There's some really interesting stock picking to be done outside of the United States. In most cases, the best investments are one that we just keep our eye on the ball. We keep focused on fundamentals, and everything else kind of takes care of itself. If you look at some of our great investors over time, one of the best things that they don't do is...
Today, we're joined by Brad Freer. Brad's been at Capital Group for 30 years. He's based in Los Angeles, 2 offices down from mine. And Brad, I have to start with a very, very personal beginning. So for our audience, I will let them know. Brad and I met in Singapore just about 30 years ago. And our families had been friends for 3 decades. 5 of our 6 combined children were born in Asia. And Brad, I followed you to Hong Kong. We were in Singapore, we went to Hong Kong, we lived in the same building. And before we get to your investment career, I'm going to surprise you and talk about your acting career. Now, so for the folks, we have both listeners and viewers. And for the folks who are listening, I do encourage you to watch on YouTube, because what I have up on the screen behind is a picture of 2 folks dressed like Winnie and Tigger. And Brad, I'm going to ask you to describe what happened at this event.
Well, it's nice that you're starting this with probably one of the great epic fails of our joint careers. Basically, I think we were asked, actually told by our wives, that we needed to wear full body Winnie the Pooh and Tigger costumes for, I believe it was your daughter's first birthday and we were having it at the apartment complex. We did not know that they did not breathe whatsoever, the costumes, and that we did not know that it was going to be incredibly hot and humid. So that was a bad aspect. The worst aspect, I think, was that by the end of the party, I'm pretty convinced every single child had cried in fear of Winnie and Tigger.
So this is, I will remind you, this is what happened. So it was Sophie's first birthday, the year 2000. And when we did this, we really thought the kids would love it. Like, Winnie and Tigger are here.
Right.
We did not know that when you're 1, it scares you to death. It does not excite you. So we added insult to injury when we realized that they did not find this funny. We, for some reason, thought it'd be a good idea to start wrestling.
Right.
That did not work.
Yes. I believe that most everyone in that room has had a complex for years when they thought about Winnie the Pooh and Tigger. And
yes.
So, yes, that was a great moment in our parenting lives.
Good. All right. Well, 30 years ago, we didn't see each other, see that we'd be sitting 2 doors down from one another working at the same company, because I was not at Capital Group then, you were. So it's a blessing that we are working together. You and Lee Nipris in Asia really started our trading effort there. Can you talk about that in the 90s?
Sure. Lee had moved to Asia, to Singapore, a couple of months before I did. And this was in 1996. And at the very end of 96, beginning of 97, we effectively were asked to set up a trading desk in Singapore, an Asian desk. We had little to no experience. Why they chose us is beyond me. I'm sure the Capital had the foresight. Of course, 4 or 5 months later, we had the Asian financial crisis, which was a remarkable experience to go through. And I think really in hindsight, what they got were 2 guys that were really hungry, willing to work, wanting to learn, and were competitive and adaptable. And It was just a remarkable learning experience. I think we did a pretty good job. Interestingly, in the next 2 years, we hired 3 traders: Mark Lim, Jonathan Wright, Tim Southwell Saunders. And all 3 of them, along with Lee, have been working together for 25 years as traders. I mean, it's an amazing thing to think about, and all are friends.
Yeah, that desk in Singapore is a 3-way married couple in lots of ways, with Mark, Johnny Wright, and Lee having been on the same desk together for a quarter of a century. It's pretty cool.
Yeah.
You've worked in 10 different Capital Group offices, which is remarkable, by the way. And I'm going to put you on the spot and ask you to pick your favorite.
Well,
and you can't choose 2.
That's an impossible task. And I'd probably punt a little bit, but I think there's a reason why. And that is that each and every office has all of its specific nuances that make them unique. Interestingly, I can say without a doubt that all of them, though, have this core underlying element where they have the value system and the culture that capital, like the real important parts, are similar.
Right.
And really, when you take all these unique offices and frankly, different points in my career and in my personal development, it's hard to compare. What I do know is all of them in different ways had a big impact on how I invest today, and how I think about the world, risk. Frankly, I also think that they developed me as a person, and they helped. They really helped me see the world in a different light, and they frankly also gave me lifelong friendships. All because capital asked and I said yes, which is something that I think a lot of people need to do more often, is just back themselves and take the risk and do it.
In your investing, you talk about a tingle of paranoia and how you think about finding ideas. What does that mean?
Well, so for context, I have spent most of my career either investing in the small cap universe or the emerging markets. And in those 2 areas, you really are spending much more time developing a competitive advantage in understanding the breadth of the market and kind of using pattern recognition, maybe more than at times going super deep and analytical on any one company.
Right.
With that, I think it's, you make a lot of mistakes at a company level, and you learn from those things. But there are times when everything's going right. And I really try to remind some of our analysts, and frankly myself, that when everything's going right, you need to get paranoid. You need to think about what can go wrong a little bit more. And in fact, what I've learned over time is that some of my very best investments have come when I'm most paranoid, frankly, almost nauseous to recommend a new company. It almost means that you've thought harder about what could go wrong and all of the risks. And frankly, it also says that the stock is probably very controversial.
So in many ways, you're taking the other side. You're pushing yourself to think why you wouldn't own it in so many ways to make sure you get over the hurdle for why you do own it.
Right, exactly.
Okay, that makes sense. You're a global investor. Talk about opportunities outside the U.S. and use sort of a 5 to 10 year time frame. There's a lot of folks who are very, very heavily weighted into U.S. stocks and the U.S. dollar. And it's worked for 15 years.
Right.
But there's a ton of opportunity outside the U.S., both owning non-dollar securities, but also for some of the companies and countries where you could have great 5 to 10 year returns.
Right.
What are some of those?
So I think it's really important to remind investors that if you look back 15 years, you were in a situation when the U.S. had lagged the emerging markets, for instance, by 700 basis points compounded for a decade. The U.S. was trading at a discount to the emerging markets and the all-country world index. And not many of us were thinking about what could go right in the United States after the global financial crisis, right?
It's good context, yeah.
And so fast forward to today, and I think we all know what can go right. It has gone right in the United States. The United States trades at a significant premium to the rest of the world, especially the emerging markets. And it's outperformed the emerging markets by over 900 basis points compounded for 15 years,
which is a remarkable.
I mean, I would bet that is record breaking.
Right.
So the easy argument is just a reversion to the mean type of an argument, but I think that's a lazy argument in a way. A lot has changed. Countries change. And if you look at it from 15 years ago, the emerging markets have better balance sheets. They have a broader group of companies. Remember, 15, 20 years ago in the emerging markets and in some other countries, we were really investing in utilities, commodity stocks, state-sponsored companies. Fast forward to today, and you have world-class financial technology businesses. You have incredible social media businesses. There's a lot, you have some world-class banks, et cetera. So the investing universe is better. Countries themselves have their financial structures are better. They have the inflation is more under control. There's less government debt. They're more focused on corporate governance. Those types of things are really important. So you're getting that at a discount to the U.S. market by quite a bit. So I think there's some really interesting stock picking to be done outside of the United States.
A lot of our guests on this podcast have talked about that, where the domicile's actually less important today than ever of the primary listing.
Right.
Because so many of these businesses are actually global in nature. Let's talk about India specifically. You've been going to India for so long. I don't know how many times you've been there, a lot. And you wrote something along with a couple others at Capital Group about the opportunities in India that the Prime Minister actually retweeted. And I'm guessing the Prime Minister of India has more followers than we do.
Right.
And so can you talk, and on the screen behind, it looks like the Prime Minister has 102 million followers retweeting Capital Group's story. And it said, will India be the breakout emerging market this decade? ? So tell us about what you wrote and what was the answer.
Well, first of all, if you have 102 million followers and only 900,000 read it, that makes me feel less good.
That was early.
Oh,
sure,
okay.
if we look today, it's a lot more.
Exactly. Yes, what we were doing actually, it's kind of a crazy story. As many would know, many of our funds have a large exposure to the Indian stock market through a number of investments, and we wanted to remind our U.S. investors why that's the case. On one side, the Indian stock market's done really well. So unlike many of the other emerging markets, the Indian stock market, 1 year forward, the valuations look pretty expensive. So why would you hold them? And we wanted to reiterate that I think India has one of the best setups for a country in the world right now over the long term. They actually have leadership that's investing very well in infrastructure, something I did not see for the first 25 years I looked at India. They are digitizing at an unbelievable pace. The Prime Minister's office is looking at governance more than they had in the past. And they have inflation under control, and that's a really important thing. So they have the opportunity to cut interest rates, and so you can go through a number of important factors where they are advantaged. They are seen as kind of a countervailing force to China. So if you believe that many companies and governments need to diversify their supply chain, India is a great place to do that. And the other thing that they're blessed with is an incredible slew of entrepreneurs.
And you've been invested there for so long, and our clients have benefited from that. I read a stat, you have to tell me if I'm in the right neighborhood, but in a lot of the European countries, the median age is in the mid 40s. The US and China, interestingly, are exactly the same, where the median age is 39. But in India, it's 29.
Mhm.
So the population, this growing, young, vibrant population, there has to be this long-term secular opportunity. There may be periods where the valuations are relatively cheap or relatively expensive, but from a 10, 20-year perspective, it feels like just an incredible
It
opportunity.
has a very different profile than Europe, Japan, China, a number of countries that way. And, we've talked about this for years now, but you really have this unbelievable situation where the GDP per capita is quite low, but you have a large number of individuals who are going into the consumer class and are going to have a multiplier effect on a lot of areas that I think are important.
In your portfolios, you tend to hold very little cash. So what is your typical cash holding as a percentage of your total responsibility, and why do you hold so little cash?
It's very low. And the
Below
first
5%?
Yeah, it's 2 to 3%
Generally, yeah.
Generally, and sometimes it's less. There are probably three reasons. The first is, this is not false humility. I think that there are some people at Capital that can do a good job, certainly better than me, at timing the market, moving in and out on the margin, and taking advantage of those things. I am not one of them. I have not done that well. And, having worked here for 30 years, you kind of get a book of record and you just know that. Second thing is, we have these great analytic groups, QRA, quantitative research
yeah.
analysis group. And they do a lot of attribution analysis for us. And now it's actually backed by data. We do a better job of buying stocks longer term than the return of cash.
Markets do better than cash.
Right. And so I think that we just always need to do that. The other piece, though, and I think this is important and everyone is different, but I really find it to be a healthy discipline, needing to sell something to buy my next idea. So looking at my lowest relative conviction idea in the portfolio and forcing myself to take a fresh look and say, you know what, maybe it's not as good as I thought, and it's certainly not as good as this next idea, and that there's a healthy tension in that.
Yeah, that makes a lot of sense, because it is a forcing mechanism. Very low cash, someone comes up with a great idea, you got to fund it.
Mm-hmm.
And getting rid of your lowest conviction position to fund a better idea is a great ethic.
Mm-hmm.
I like that. I'm going to quickly take a break and head to the office treasure hunt. Another one from our lives together, Brad, having known each other and been friends for almost 30 years. So I am going to ask you to describe what I am holding up in my hand. So describe this for our listeners, if you would.
So all of us have our fun stories with taxes over the years. This is one of the greats, I think. In 2001, within 12 days of each other, I received a tax refund check from the US government and from the Hong Kong government. Now, both of them happened to be $10. The US one, $10 US. The Hong Kong one, 10 Hong Kong dollars. Now, of course, that's a low amount, and I'm sure that it costs more to process and mail those checks to me than the $10 would indicate. Remember, 10 Hong Kong dollars is about $1.30 or something like that. And so I went into my local Citibank branch and tried to deposit these. Of course, the U.S. government check, they said, well, it's going to cost $25 because it's an international check, and we have to put it on hold. I thought that was ironic, because if the U.S. government's treasury check bounces, that's a problem for Citibank.
$10 bounce into a U.S.
So I came back, decided not to deposit the checks, obviously, and I had to call my good friend from Citibank at the time and vent a little bit. he then called my wife, Lisa, and said, I got to get these checks and frame them. And so if you turn that over, Mike, I think you will see a very clever comment that says one tax, two countries. And at the time, it was there was a Hong Kong saying that the Chinese government said one country, two systems, I believe. And you will see who signed it. It was this guy named Gitlin, I believe. And so he had framed those two checks. And that has traveled with me, by the way, from Hong Kong to Los Angeles to London London back to Los Angeles. So.
That was so funny. I remember you telling me. I was at Citibank at the time, and I remember you telling me I literally have two checks from two different governments that are both $10 in different currencies that I really can't cash. So we had to do something fun with that. Let's talk about some lessons learned. You've invested for 30 years. You've learned some lessons. Everyone makes mistakes. Share with us one or two of those, if you would.
So I'll give you two. And the first, I remember actually a friend and mentor of types, Andrew Sussman,
based in our New York office, been
yes,
with us for a long
just
time.
A classic. I took over my Australian coverage from him in 2000. So in the year 2000, 2001. So that kind of dates it, right? But one of the things he has always said, which I think is so true, and that is that, if there's an income statement problem, an earnings problem, time can solve that. Time can, things can turn around and companies can withstand that. And if you're right, longer term, it's fine. If there's a balance sheet problem, it can be terminal.
Right.
It can, in a good scenario, a problem balance sheet will sometimes cause dilution of your equity holding. But if you're covering small caps, like I have for multiple decades, it can create bankruptcy, and that is not fun. And so that's the first thing. The other thing is, if you look at some of our great investors over time, one of the best things that they don't do is tinker with their portfolio. And by that, I mean, there's so much noise out there, and the noise can be in news stories, but it can also be in share prices, and they can go up and down with volatility and move 5%, 10% in different areas. And I have tinkered over the years with companies that have had terrific fundamentals, and the thesis continues to play out like we expected. And in most cases, the best investments are one that we just keep our eye on the ball. We keep focused on fundamentals and making sure that thesis is right, and everything else kind of takes care of itself.
So too often you would touch it, raise your weighting, lower your weighting, raise it lower, as opposed to just own it.
Yes, exactly.
And so you found out that owning it's just better.
That's when the magic happens.
Got it. Speaking about the magic, every one of our investment professionals has their own unique edge. What they do in their own discipline to create value for our clients over the long term. What's your investment edge?
So I think that mine is playing the player better than most. And by that, I mean, at Capital, as portfolio managers, we have an incredible benefit. We have the best investment analysts on planet Earth. And those analysts are actually investors themselves. And thankfully, we have an incredibly diverse group of investors across, 3 different continents, in Asia, Europe, and the Americas. And for a large chunk of my career, I was either the head of research or I was overseeing the research directors in what we call the Research Coordinating Committee. And when you do that, you end up really studying all of the individuals in the research team and their nuances quite a bit. You get to know their strengths and their weaknesses. And so when you take a diverse group of people from lots of different cultures, you learn to where to kind of discount if they're, really optimistic and they tend to overshoot on earnings, and maybe, they might exaggerate what the opportunity is. But more importantly, we have quiet voices, and sometimes they're really risk averse or more risk averse. And I have found that being able to interpret those quiet voices and those lonely ideas sometimes can be a real powerful tool.
So you've effectively, in some ways, made a career of analyzing the analysts. I mean, you get to know them so well and their strengths and weaknesses, and when they really have conviction and when to lean into their ideas, that it helps add conviction to your own portfolio.
Exactly. I mean, we can take what we call the research portfolio, so all the analysts that are invested. And I think as portfolio managers, one of our greatest jobs is to amplify and really leverage that as a starting material, but then interpret the best ideas, that especially if they're not as well owned.
Got it. Share an idea or two with us today. What's on your mind in terms of where are you investing, where you have your highest conviction?
Well, I'm probably going to surprise my colleagues by not talking about an Indian company.
Okay.
And I'm going to talk a little bit about a Latin American financial technology company called New Holdings. And
NU.
Right.
NU Holdings, is that how you spell it?
Yes.
Okay.
NU Holdings. It's a $50 billion financial technology company in Latin America. And there are a couple of things that I'd speak to. First, this kind of is a good example of playing the player. Jeff Garcia, who was hired in our early career program, I've known him since day one. I actually hired him as a research director. I know him really well. And this is a company, New Holdings is a company that he got to know and others knew through connections and shared experience. They knew the founder through Stanford Business School, actually. And then we also were able to leverage our relationship with Sequoia Capital and the private markets. They had invested very early in New as a portfolio company. So we invested in New in December of 2020, actually right before the IPO. And it's a company that we were able to understand the power of the disruption that they could do in Latin America. Because in Latin America, in Brazil in particular, where they started, you had state-sponsored banks and private banks that charged onerous fees. They priced their loans at very high interest rates. So there was a pricing umbrella. New came in with a cost structure that was very different. They were almost 100% digital, and they were able to generate a better customer experience and have better pricing. And so they rapidly took market share. And to put it into perspective, from the time of the IPO to today, they were able to grow their customer base 300%. So 300% in 3 years to 90 million customers.
Okay, let's shift as we're closing down here. Let's shift to mentors at Capital Group. If I could ask you to pick one or two, who would you pick?
I'm not going to follow your rule. I will do 3 quickly.
Okay, 3. All right.
Okay,
This is going to be a record on this podcast.
Yes.
3 mentors.
All capital.
Good.
So first, Joe Higdon. Joe Higdon will go down as one of the great hirers at Capital Group. And
wait, did Joe hire you?
that's
okay,
actually,
hold on a second.
I wasn't going to say that, but
yeah, all right.
But he hired some great investors and some great leaders at Capital. Not me. He did hire me, but I'm not.
That's
in that
not why.
boat. Yeah,
okay,
yeah.
I understand.
But I think what made Joe different wasn't the transaction of hiring. It was that he knew the importance of becoming an ally and backing you when you needed backing. When things were lonely or you're having a tough time, he was there. And I think that's a really important reminder that mentorship is not just this, I'm going to get this guy into the company. It's around building that.
And good advocate.
Right. Next one, Gordy Crawford, who you know.
Very well.
Gordy was probably one of our most insightful analysts and was a big personality. But I think Gordy, one of the wonderful things about Gordy is that he's an optimist by nature. And when he did the work and he had the insights, he was proud to dream about what something could become. And it's infectious. And it was not just with his investing, it was with how he thought about capital and what capital could become. And I think that was a really important one. Final one is Jonathan Knowles, who is very different than those two. Jonathan had one of the great investment frameworks that we have had at Capital, very successful, but he also worked harder than almost anyone else. He thought it was important. That was an important part of being an investor, and we owed it to our client base. Guaranteed he visited more companies, had more one-on-ones with companies than any person in the history of Capital. That was the way he thrived. But it was that work ethic and that framework and being so rabid about focus on investment results that I will always appreciate.
Yeah, legendary investors at Capital Group for sure. And Jonathan just retired recently as well, but added so much value to clients over such a long period of time, as did Gordy and Joe. Mm-hmm. All right, Brad, we are going to end with a moment of gratitude. Mm-hmm. And I'm going to share with you the largest ever mug. And by the way, these mugs, people have asked about these mugs. They like them, and we got to find a way to make them more available. But the back of the mug says, "Be obsessively grateful." So I'm going to give it to you to keep, but I'm also going to ask you what you are grateful for. Personal, business, anything goes.
So I guess I can't say coffee.
No, not yet, until we fill it up.
Okay. I'm going to say two things quickly again. The first is something we share. I don't think that we can talk about this without me being grateful for Lisa and you being grateful for Chrissy.
Right.
I have a wife and best friend that has followed me to 4 different countries and is independent and is so dang smart and strong that she's willing to do that, and because she backed us to succeed and grow that way. That takes a lot of sacrifice, and there's no chance that I would have been as successful as I am without that. And I think you would agree that
plus.
Yeah,
yes.
Exactly. But the other thing I think on a CG level, this has become just increasingly clear the longer I've been at Capital, is I'm very grateful that our forefathers started with the principle of integrity. I think it is incredibly powerful that every single person at this company knows that the interests of our shareholders come first, and that it's absolutely unacceptable to compromise on integrity. It self-selects for the people that we get to work with every day, and that makes the culture of this place better. It frees up mind space and emotional areas so that we can actually focus on investing or marketing or doing whatever our day-to-day job is. We don't have to think about what's going to happen over here or that. And selfishly, it means that we don't have to wake up every morning worried that we're going to have to make excuses to our friends and family that we work for a company that we're not incredibly proud of.
Yeah, that's a great way to put it. Our core values have evolved over decades and decades, over our 93 years, but the one constant has been integrity. Mm-hmm. And it's a good one to point out. I'll end with a quick one, and that is being grateful that Chrissy and I met you and Lisa in Singapore 29 years ago. Our families are still incredibly close. And I just Never thought 29 years ago, working at Citi while you were at Capital Group, that our offices would be next to each other in downtown LA.
Who would have thought?
Who would have thought? So I'm super grateful for that. Thanks for joining us today. If you enjoyed the podcast, spread the word to somebody else who might benefit from hearing these great stories from our investment professionals. And also, please subscribe to Capital Ideas wherever you get your podcasts. And have a great day.